Hello, in this presentation we will define balance sheet. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of balance sheet is financial statement that lists types and dollar amounts of assets, liabilities, and equity at a specific date. Some key terms here are, of course, the accounts that are going to be listed within the balance sheet, which will be assets, liabilities, and equity, the three components of the balance sheet, and the fact that it's going to be listed as a specific date in time. We're talking about a point in time rather than a range of time, not a beginning and an ending, but rather just a point in time when considering the balance sheet. The three components of the balance sheet will be assets, liabilities, and equity, and that is our accounting equation of assets equal liabilities plus equity. Therefore, the balance sheet represents what is owned by the company, which would be cash, land, equipment, supplies like this building. These are the types of things that the company owns. The balance sheet will express these types of things as the assets, but of course will do so in terms of dollars. So we're going to say this is so much dollars worth of land, so many dollars worth of equipment and car or auto, so much dollars worth of supplies. Whatever the company has, they will then owe to somebody, whether it be a company or sole proprietor, any business. We're going to express what the business owns and who the business owes to, either a third party or to the owner. So the liabilities then on the balance sheet will be the third parties that are owed something. Third parties like creditors, people that we bought something on account for and therefore owe something in the future. Possibly the bank, if we took out a loan or something like that, that we owe in the future. Again, expressed in terms of dollars. And then we have the equity section. Anything that is not owed to the liabilities, so any assets we have minus the liabilities, would equal what is owed to the owner being the owner of the company, and therefore the book value, the assets minus the liabilities, would then equal what the company is worth on a book value basis, and therefore what is owed to the owner. So the assets are what the company has in terms of expressed in terms of dollars, and then the liabilities and equity on the balance sheet are who the assets are owed to. If we look at a balance sheet, we're going to have a date as of a point in time, not a time frame, not a beginning and an end. And we're going to have the assets typically broken out into current assets and then property, plant, and equipment. Current assets being more liquid assets, assets closer to cash or closer to being consumed. Property, plant, and equipment being long-lived assets, assets like land, assets like depreciable assets like building and automobile, those that are going to have longer lives, those that we depreciate and expense over time in the form of depreciation. The next component will be the liabilities component, where we have the current liabilities and the long-term liabilities. The liabilities are what the company owes to. So the current liabilities are going to be those that are owed within a year. They're going to be due within a year's time. And the long-term liabilities are those that are going to be due outside of a year's time. The idea of breaking these out would be that these are the obligations that are in the near future, and we can compare them to the types of assets we have in the near future and see if we are going to be able to pay off our current obligations. And this is a really important comparison because, one, we want to make sure that we can pay off these current obligations, and we're not quite as worried as the long-term obligations because they're not immediately due. And we want to make sure that we have the current assets, and especially the cash at some point, needed in order to pay them off, other than having all of our assets into like property, plant, and equipment, which would be difficult to pay off those current liabilities. So it's a good comparison to be able to have between the current assets and current liabilities, the reason to break those subcategories out. Then we have the equity section of the balance sheet, and that could be thought of as assets minus liabilities. It's the remainder that is left, the book value of the company. And if we then took the liabilities and the equity, then that would give us the total liabilities and equity. Total assets are our accounting equation of total assets equaling total liabilities and owner's equity on the balance sheet. If you want some more information about the balance sheet and related topics, we suggest taking a look at Accounting Instruction reference number 100. One of the major components of a resource like this is that you're going to have a table of contents jumping into relevant content as is needed, and then you can see the information around it and navigate to what you need a bit more easily. Within the book, we have references that will jump directly to instructional videos such as this, such as definitions, other PowerPoint videos, as well as test banks and problems that you can work through, Excel worksheets that would support this type of information, which can be very helpful to understanding as well.